Hi, Mike Swanson here, and this is a quick video and article about support and resistance, the supply and demand of factors that affect individual stocks, and they're the underpinnings of technical analysis and truly understanding what moves the stock market. Uh, you know, Supply comes in on a stock when people think a stock is at an expensive price and they start selling. Demand comes in when a price falls to a certain level that they now think the stock is cheap. And these behaviors create areas of resistance where stock has difficulty going up, and support. The demand levels where mass demand comes in creates support, prevents the stock from falling. The key thing you need to understand, though, is what makes this happen. Because perceptions change when it comes to whether stock is expensive or cheap. And it's these changes that you need to understand to make money using technical analysis. And of course, a stock can be $10 a share, and then say, it stays at 10 for months, or well, I'll put it to you this way: whenever it goes up to $10, resistance comes in. For example, look at this stock here. This is CGA. When it was trading here, 8.5 was resistance, 6.5 was support. Whenever the stock would get up to 8.5, people would think it was expensive and they'd dump it. And when it fell to 6.5, they'd sell. Well, at some point, all the people at 8.5, they exhausted all their shares. They sold everything they owned. Those people were gone. And without that overhanging supply, the stock shot up to a new level where $14 became resistance. Why does this happen? Well, of course, the most obvious thing to everybody is that news comes out. Good news comes out that takes people by surprise. Could be good earnings, a new contract the company's signed, whatever, that makes the stock now worth more in the eyes of investors. So the stock goes up. Or bad news comes out and makes the stock decline. And when you watch the financial media or look at news stories and see stock prices move, you start to think this is how the stock market operates, and it's just random news breaking out all over the place, tumbling the market or making the market go up. And you're simply, if you're in the stock market, you're simply caught up in the swirl of events. In reality, though, that's just part of the story. And the real story is where you really make money, not guessing news or buying on rumors before the crowd does, but understanding this concept that stock prices don't only move because of news stories, but more importantly, because the movements of the prices themselves affect people's perceptions of stocks. For example, let's say I bought a stock for $10 a share, and it fell to $7. And then it went back up to $8. Then it fell back to $7. It went back up to 8.5, fell to 7. But I'm in at 10. I'm sitting on losses. And I'm watching the stock gyrate like this. And then I see another stock I might want to buy, or I'm just tired of the situation. I don't like sitting on these losses. And I say to myself, if this stock ever gets back up to 10 bucks, I'm going to sell it. Well, now when the stock goes up to $10, in my perceptions, hey, that stock is now expensive, and I sell it. Well, here's another scenario. Let's say I'm watching this stock. It's at 20 bucks, and I'm thinking about buying it. I've heard some good stories about it, or I just like it. But for whatever reason, I'm a little fearful and I hesitate. And then I look at it the next day, and it's at $30 a share, and I'm kicking myself because that's a huge gain I missed out on. And I say to myself, if that stock ever fell back down to 25 bucks, hey, I'll buy it. And other people are in the same exact situation I am, and are thinking the same thing. Some of them want to buy it at 25, some of them at 28, some of them at 20. And what happens? The stock pulls back, and all these people thinking like I do that they missed out, now they're buying in. And we're all together creating areas of supply through our demand. And our demand isn't coming from news stories. It's not coming from events happening. It's coming from our own reactions to what's happened to the movements of this stock price. And this is what really fuels the stock market. It's people's perceptions of stock prices and how they react to the movement of the market itself. It's not simply news stories. It's not simply the fundamentals underpinning everything, underpinning the economy, underpinning earnings, underpinning the balance sheets of companies. It's not just nuts and bolts fundamental analysis. That's just a fraction of what makes the market move. It's the psychology of investors, which drives supply and demand and is visible in stock charts. And this is why technical analysis is such a useful tool to use in the stock market. I got other articles about this sort of stuff on this website, so be free to investigate. But before you do that, what you should do is opt in to my free weekly newsletters, completely free. I don't share your email address with anyone. I'll give you a technical update of the stock market about once a week. We got podcasts, but we also have a document that I wrote called the Twofold Formula, in which I spell out the exact technical patterns and fundamental characteristics that I find in stocks that tend to go up the most. And I've back tested this stuff, and this is how I make my money. And I'm giving it to you for free. Just opt in, just click the link, and I'll see you on the other side.